Hello, everybody. Thank you very much. And welcome, everybody, to the Evolution of Institutional Crypto panel discussion. Is everybody comfortable, seated, and excited? Almost. All right. Let's start with an introduction round. We have Michael Lau, Senior VP Global Head of Sales at Bullish. We have Michael Baer, Senior Account Executive at Figment, and Tim Grant, Head EMEA Galaxy Digital. Can I ask you to quickly introduce your company, your role, and how that relates to the panel topic?
Yeah, sure. So, hi everyone. My name is Michael. I work for Bullish. We're a centralized exchange. We'll go into that a little bit later. But basically, you know, from our perspective, we've launched this exchange as an institutionalized leaning exchange, and so that's the reason why we're so excited to talk about this topic today.
Mike Baer, Figment, nice to be here. So we are a staking provider. We provide infrastructure that helps blockchains operate. If you don't know what a staking provider is, if you don't have staking, you don't have proof-of-stake protocols. Then I help companies implement staking.
Hello? Oh, that works. I'm judging by the low energy here. Did you guys all go out last night? Is that what happened? The first night out, I just got in this morning. It feels like I missed the main party. Don't worry, we'll sort it out tonight. Tim Grant, Galaxy Digital. Galaxy is a regulated global institutional diversified financial services company. Say that 10 times. We're in trading, we're in asset management, we're in custody through our BitGo acquisition that we're making as we speak. We're in mining, and we're in investment banking, and we have a venture portfolio.
Thank you very much. Quickly, well, my name is Michael Gauckler, unlike announced in the program. So take a photo if you want to follow up. I'm a Head Product Development and Innovation at Bitcoin Suisse, a pioneer in the crypto valley in Switzerland since 2013, offering brokerage, custody, staking, and related services to the crypto industry. But for now, it's my turn to ask the questions and not answer them. So our first question is, it's crypto winter, I would say. Crypto winter for the first time for many of the institutions, not for the OGs, but the institutions that came in a bit later than the OGs. It's the first time. So what's going on from their perspective, how they're weathering the storm?
Right. So I don't know if I'm an OG. I've been doing this 7 years, so I don't know if that probably counts as some sort of OG, right? So I've seen so-called crypto winters before. My thoughts on the market right now. So crypto was trading very much as a risk asset for the first few months of this year, which was actually a big moment of maturation for our space. That really Bitcoin, if you look at it, was trading like a NASDAQ stock for all the way until you got to early May. And then Terra Luna kind of started a series of idiosyncratic crypto dynamics. But it's really important to note, until that point, until May, crypto was just trading as a risk asset, which tells you that this is an institutionally driven market now. And that's slowly changed over time. I think you look at the Coinbase statistics from when they started to when they went public, it was really a retail-led volume that became institutional-led. Well, that's now increased even further. So that's a really key point. Like, this market is not the same market that we went through in 2017, which wasn't an institutional market back then. And so there were no institutional dynamics to kind of grab onto. Well, that's now changed. We've got truly the institutional money is really here, which is not to say that we don't have an increase in adoption cycle that needs to come. But then Terra Luna, for lots of reasons that we don't need to go into detail here, I suspect everybody here is pretty familiar with that, threw us a little bit into idiosyncratic risk territory, and now you've got the inevitable, the credit problems that have come up. And to your point in the way you asked the question, a lot of people in this market, and let's just talk about lending standards as an example, being way too lax on lending standards to win market share, and now the tide's gone out and the emperor has no clothes. And like that's just a really important point in the cycle of an asset class, to wash out those who really maybe shouldn't have been running the businesses the way they're running. But that's totally to be expected. It's desirable. And look at Terra Luna. that was actually quite an orderly kind of unwind, if you like. Like, nobody wants to see people lose money, but it unwound in a way that I think demonstrated a level of maturity. So I'm not sure if I buy this crypto winter narrative. Crypto definitely is a high beta asset in institutional terms. People call it volatile, but it's really a high beta risk asset now, which means it will go down further on the way down, and it will go up quicker and bounce faster on the way up. So is it really idiosyncratic crypto? I think the leverage in the system in crypto is materially less than we've seen in other downturns in traditional markets, and it feels like that leverage has already found its way out. So I think we've got a challenging macro picture, but I think we are still quite constructive and bullish crypto assets, especially at the point at which we hit a bottom, which I'm not calling that. I don't know when that will be.
Great, thanks for that elaborate answer. You're almost saying that the institutions know better how this is played and took away the market from the OGs. Fair point. What are the other views?
We're coming at it, Figment comes at this from a very infrastructure forward builder perspective. So a lot of the people that we focus on are the developers that are in the space that are building on these protocols. And I agree with Tim's point. We don't really consider this a winter. You have price action. We are agnostic as to prices. These blockchains work really well, even when prices go lower. And the idea that there are more developers right now in Web3 than ever before building on these protocols, these are going to be durable criteria to cause these asset prices to increase sustainably over the future. We're seeing a ton of developer activity, and it's giving us a lot of hope. We're also seeing really nimble blockchain projects being launched on a regular basis. Figment right now runs validator nodes on 60+ protocols, and we see really sharp teams every day in the space launching new chains that promise to bring a lot of value. And I think as we see the application layer evolve and people start using blockchain tech to solve problems, things will sort of stabilize. But right now, we're in a really interesting part of the space where people are taking directional bets on the future functionality of these underlying chains. And there's going to be some price swings. And just ride it out, have fun, buy low.
Yeah. No, I would say that one of the things that I remember when I first joined the industry about early 2020, a lot of my friends from outside the space would be like, so what's going on in crypto? What's happening? And what I'd always say is that if all you follow was the mainstream media, all you would get really is the news flow around price volatility and regulatory changes. But what oftentimes you miss is a significant amount of effort that's being put in by people on this stage and others in the audience of building the infrastructure in this space. And I think what we're seeing is the natural kind of, call it, swings and gyrations that you'd notice out of a nascent market. We're still fairly early on, but even if you think about some of the longer-term thinkers, before joining this space, I used to work in capital markets, and a number of the people that I spoke to were pension funds and sovereign wealth funds, and it's surprising the number of people in that space who have a long-term view, who are spending even more time and focus and interest in this space, even as we're going through this, because I feel like there's a certain, I guess, kind of alignment towards this idea that this is just part of the natural growing process of an industry that hopefully will become even, more mainstream, more adopted over time.
Thanks for this additional view. You caught me totally off script. My notes say we agree on the crypto winter, and you're saying it's not a crypto winter, but let's phrase it nevertheless. So let's say challenging times, not winter, but challenging times. And there's decisions to be made, and according to my notes, some point in time we'll have summer again, and we'll see who made the right decisions, who took an advantage of this turbulent market, if you want to call it. And depending on the segment or the player, it might turn out to be a different success factor, different decisions. So we'll go through the different players, starting over with Tim. Like exchanges, custodians, and the industry players, what would they need to decide now, and how that does affect whether they come out successful?
Well, it's interesting that the theme that came out from all three of us actually is, and I always cite the Andreessen Horowitz raise that they did recently. Andreessen Horowitz just raised $4.5 billion for a venture PE fund for this space. Why is that significant? Because the guys who figured out Web 2 definitively and made a name for themselves in finding the companies that drove commerce in the Web 2 environment have now decided and convinced their investors that this is the next thing, and they're investing in it, and they're investing in it more than anyone else. So Michael's point is spot on. Like, the builders are still building, and if you can, and other Michael's point is also spot on about, like, you got to remove this notion of this price sensitivity is a massive red herring. Like, what really matters is we're building. Now, to your question, the companies that are going to come out a year, 2, 3, 4 years from now as the dominant players, regardless of whether they're exchanges, whether they're custodians, whether they're building the staking infrastructure, whether they're trading houses or investment banks, all those flavors are the ones that are going to make the smart decisions in the coming days, weeks, and months. And my colleague actually said this really well, Katerina Jaeger, who's running our Middle East franchise. She was at the Qatar Economic Forum, and she said, you've got to focus on your customers, which I think is exactly right. I think the answer to your question is sort of the navel gazing has to stop. This is now a maturing industry with, to your point, institutional players, sovereign wealth funds, pension funds. You know, these are companies that have gone through multiple cycles of engaging in new asset classes when they've come along, and they're going to do it in a really buttoned up way, and they will demand institutional quality services. They will demand that everything's buttoned up, that it's papered, that it's regulated where it's appropriate, and like that's going to create an experience for those companies that brings them in. And the difference between all of us, assuming that the rising tide lifts all ships, we all want to succeed, that's why I love this space, because we're all going to make it, is the next level of adoption has to be significant, right? Like, the institutional money is what's going to go from, you know, the order of magnitude of volumes that we need. The derivatives market is growing, institutional staking being done in size, the exchanges growing their volumes like that. So we all have to work together and bring in these big institutions. The retail play isn't going to drive volume. It can't. That's already been done. So that's, I think, the mindset everybody needs to have. We have to really be grown up, which is arguably not that straightforward for this space, which didn't kind of come from an institutional background, which is fascinating. So everyone needs to really kind of think institutionally and not fall into the trap of thinking that is somehow selling out, right? You know, it's interesting that little tone still sits in our space, you know?
Thanks, Tim, for the view of the providers to the institutions. What about the institutional investors? Maybe Michael Lau, do you see what the right decision is for the investors themselves? Do they have to buy the dip, or?
Yeah, no, so just a little backstory. So when I joined 2020 and we were starting to build this exchange, I remember I put this presentation in front of our senior manager and I said, if you looked at the composition of players that are in, let's say, the New York Stock Exchange, 200 years old, London Stock Exchange, 200 years old, 80% roughly were institutional players contributing to that flow. And then you looked at, let's say, for example, the Chinese stock markets, 60 years old, 60% institutional, and I remember back in the day, it was often talked about, look at how retail, you know, these particular exchanges operated. And you looked at ours, and it was very much this kind of like maybe best guess 5% institutional. It was heavily retail driven. And I think there's a little bit of this history kind of playing out, right? Kind of from first principles thinking. I think that people will begin to realize that this is a significant asset class that they need to participate in. But not everyone has the time or ability or attention to be able to manage their money or manage their assets in a certain way. And so I think there is going to be this kind of professionalism that's called for from this industry. And I think that given the current space where we're in right now, it's, you know, I think before it was simply a matter of an access product. How do I get exposure to that performance? Now it's, how do I understand risk and also achieve that in a way that actually helps me to, you know, basically, achieve long-term growth, or even if it's short-term, but be able to manage it to navigate this space. So I do think that from an institutional investor perspective, those that are able to provide that bigger picture, understand risk, understand how to be able to achieve performance with that mindset, I think those are the people that are going to win out.
Well, and middle, Michael, I will add this, the institutional, you're alluding to the level of rigor with which institutional investors will look at the space. What's really exciting to me is seeing some of the really big investors, big hedge funds, talking about the idea of a token analyst. We've got fixed income analysts, we've got securities analysts, we've got FX analysts. Why wouldn't we have token analysts? And I think that's now seeping into the smarter guys in the room are realizing, well, in order for us to have a view on a project or the economic viability of a company in the DeFi space, I need to develop a new set of tools to establish the valuation mechanism, which is really not obvious to a traditional frame of reference. And I think that's a really cool moment in time. That it's going to take a while, but I bet you'll see job adverts for token analysts at some point in the next couple of years, because it is, as my colleague Rob Bagucki said in the Wall Street Journal, the fifth asset class, right? It's a new asset class that needs and it demands you look at it with a level of rigor that big institutions won't invest without it.
So in summary, the institutions bring in the professionalism for this next wave of development. So in terms of functionality and projects, Mike, do you see anywhere where there are special interesting things where stuff is being built, there's enough funding and talent and resources to go through the cycle, and we come up on the other end with something that's interesting to the institutions but not around yet?
Yeah, I'm not going to sugarcoat it. I mean, some of the founding teams that we're working with have decided to pause the launching of their chain until prices recover a little bit. This makes sense. I think it's good management. I think at the end of the day, this is going to dovetail on what Tim was saying. Like, the idea of a well-run company is not foreign to an equity analyst that wants to make sure that the board of directors, CEO, et cetera, are making the right decisions for the company. Protocols that stand the test of time need to be well-run as well. It's critical, really, really important. I think if you look at protocols like Ethereum that have responded really, really well to changes over time, they have not always been, the sterling name that they are right now. They've had some trouble. They worked through it. So I think, we're generally bullish at Figment because, we see these founding teams make high-quality decisions all the time. They have really well-funded projects, and the governance structures behind these token projects are really sophisticated too. They want to ship products and stay head down shipping products, and that's what we're doing too at Figment. We're really focusing on our end customers, who most of the time are custodians, exchanges, some wallet providers, et cetera. We need to make it easy for access, staking access in particular, like Michael number 2 mentioned, the ability to bring stake to proof of stake protocols and give comfort to these founding teams that really high quality validators are in the space, and keeping their blockchains running and their governance structures running are really, really important. So we're heads down shipping.
Cool, thanks for these explanations. One important topic for the institutions is regulations, and I know that there are other streams that are much stronger and longer talking about regulation, but just the connection between the regulation and the institutions would be an interesting point I want to raise. Answering it from the perspective of Bitcoin Suisse, we're committed to Switzerland, being regulated in Switzerland, not doing the regulatory arbitrage and jumping around. And we're also seeing it from the clients that we have to do this, because lots of the OGs where our early customers now have the big bags, and the big bags are wrapped in funds and structures that require regulated services, regulated structures. And of course, we're going to provide this. How do you see this trend? This is a necessity, and the institutions driving the regulation, or are they sitting on the fence until it's cleared out?
Well, my 2 cents on this, it's back to that point of, for this to really succeed, we need the regulation, because the big buttoned up asset management, or the asset allocators, the people who have the assets, will demand nothing less. So this is sort of non-negotiable and always has been. I think we might look back on this moment in a couple of years as a turning point, because Europe has, in the space of a few months, gone from Switzerland, which was always a very positive story, relatively speaking, globally, where you were able to get the policymakers, the central bank, the social acceptance, arguably as well, and the regulators all aligned to generate change, which has now made Switzerland sort of punching way above its weight in terms of its impact in crypto. Singapore tried to do it, and not so much. But then look at the rest of Europe. It was always a bit behind. Germany did a great job of sort of allowing the special funds to invest a certain amount of money into crypto. But France was a holdout, and the UK was seen as a negative. It was seen as really not wanting to get involved in crypto because it threw the baby out with the bathwater with its original policy changes a couple of years ago, where they were trying to protect the retail consumers from leveraged crypto product, which I think we should all get behind. That's a good thing. Let's not put these weapons in the hands of retail. But in doing so, they shut off the potential, for example, to a crypto ETP in the London Stock Exchange, which meant that that's one of the key starting points that Germany and Switzerland are already way in advance of. Now, what's happened in the last couple of months is Rishi Sunak, the Chancellor of the Exchequer in the UK, said publicly they want the UK to be a global crypto hub. This is not to be underestimated. This is a bold statement from the very, very top in the UK that they're doing a 180. They were open for business. Now, they've still got to do some policy changes to follow through on that. But then Binance gets regulated in Paris. No one saw that one coming. Paris was traditionally quite negative, and suddenly Binance gets regulated as the first G7 country to kind of get behind Binance's model. And that basically said, and if any of you were at Paris Blockchain Week, you will agree it was heaving that week, right? That Paris is now open for business. So we've now got this totally different tone in Europe from 6 months ago, where the UK, Germany, France, and Switzerland are all, and right there you've got the majority of wealth of the European bloc in those countries. Like, that's a pretty significant turning point where now the big institutions will feel incrementally more inclined to get in because they're seeing the nod from the policymakers. I think it's an exciting moment, and it'll be interesting to see what happens for the rest of the year.
I'd say that, like, at a very high level, greater regulatory clarity brings confidence. I think that there's a lot of people who are trying to do the right thing, but because of that lack of clarity, oftentimes it becomes difficult to navigate, and to a certain degree, it then takes up a significant amount of resources from these companies from developing, because they're trying to make sure that they're working out kind of this somewhat uneven, non-uniform kind of set of jurisdictions. I think that definitely regulations that promote consumer safety is good. I think the need for us to make sure that that's balanced with the ability to continue to innovate is also very important. But I do think that, when for example, a couple of years ago when DeFi Summer happened, I spoke to a number of these institutional investors, and they were saying, hey, we're really interested in DeFi. And, I kind of kept talking to them about it, but they're like, we can't do anything about it right now. And what I began to realize was if you kind of deconstructed it into this kind of DeFi as programmatic finance and then decentralization, there was a deterrence with that because of regulated related matters, because they themselves were regulated, even though the space is not regulated. So they demanded out of that the need for KYC and AML, so therefore they couldn't touch it. And so I think there's an element of both this space getting that clarity, getting more confidence, but also fitting into the wider picture of kind of how capital is flowing and how this also plays in to match what, for example, these other institutions do as other businesses in their own right, so that we can actually see greater adoption come through.
Thank you. Out of personal interest, I have another question which wasn't on this notes. When we got blockchain and crypto after the financial crisis with some ideology of creating a more inclusive financial system, something that doesn't depend on a central counterparty, and the institutions are now jumping on these trends, looking at the charts, creating products and services around it. And is there a disconnect, or is there a giving back from the institutions, or do the institutions understand what the original idea about crypto was? Or could we also, instead of looking at Bitcoin price charts, do products on weather derivatives if they would be as trendy and popular as crypto is right now?
I might take a whack.
Go for it, go for it.
I think to the extent that the institutions, especially the banking groups, are building on public blockchains, very, very positive. They're going to have to follow the same rules that everybody else does. There won't be a gating mechanism. They'll simply providing like products and services that use the core functionality of the chain. So I view that as very bullish.
You know, it's actually it's a very good question, because you know to some extent we don't talk about the why as much as we should in our space. We all know the sort of relatively libertarian ideal that gave birth to Bitcoin, and we all get the power of decentralization up to a point. Like, it really doesn't make sense to decentralize everything. Bitcoin in itself proved that you ended up having to have certain centralized institutions in place to make it all work, and there's nothing wrong with that, as long as they're not fattened intermediaries, and that's what we're trying to. You know, the transparency should allow us to sort of not fall into that trap again. But it does beg the question: if I'm a very big sovereign wealth fund or a very big asset manager pension fund, am I buying into the narrative here? And the narrative is faster, better, cheaper, democratized access to financial services for corporations, governments, and individuals, which, if it's done right, should remove a whole bunch of friction, should enable and support growth, and should enable people who haven't had access to things to have access to things now. Like, that core idea is really important. And it's funny, I can't remember having a conversation about it recently. You know what I mean? Like, perhaps your question is spot on. Like, should we be sort of taking our eye off the price action and actually start to talk about the why a bit more? And I think a lot of organizations will buy into that.
Yeah, no, I'd say that, like, I think what I've always found really fascinating is, like, for people who are in this space building, there's always been this kind of philosophy of trying to get value back to the individual, right? More and more of that value back. And I think to a certain degree, like, there's an element of mature 100-year-old industries that have had these intermediaries come in, all rent-seeking, of course, that have kind of, you know, added on layers of friction or added on layers of cost, that as people being early in this particular industry building, we want to try to make it so that we're building on first principles. There's a need for this service, therefore we will build. We obviously need to be able to pay people for doing that type of job, so we'll do that. But at the same time, it's, you know, this idea of trying to get back to this flow of value, back to the user, back to the creator. And I think whether or not you're working on a decentralized project or a centralized project, I think underlying this industry is this kind of understanding that we're trying to build it from that perspective. And I do feel like from that, and there will probably be greater benefit, you know, and greater inclusion around those who can participate, those people who can actually create value in this space. Yeah, and so I do feel like we're all working towards that direction.
Cool. Thank you all for those wonderful answers. Is there any one good last question from the audience? Yes, over there. Please stand up and shout it out. After the whole Terra Luna, do you think that institutions, please?
Is it around, have institutions lost some trust in the system because of that?
Lost trust in lending.
Lending. No. This whole lending thing is really straightforward, right? Like, see, what I find sometimes funny about our space is we use these terms called crypto economics. There are no crypto economics. There's just economics. There's always been economics, and it's just another set of tools to engage with economics, right? And so lending, I mean, you can't tell me that 20% return on Anchor protocol, which, by the way, if you're an institutional investor, is a really, really risky high-yield bond that has a very high chance of defaulting, right? That's the rate of return you would expect. And anyone in their right mind would say that was sustainable. Like, it just doesn't work that way. You can't magic up the money out of thin air. At some point, you get caught out, and that's exactly what happened. That's just one example. The lending community was being too lax. You can't lend uncollateralized and then expect not to take losses when there's an inevitable downturn. It's just like 2007-8 all over again. We put all these models together that assumed that real estate, AAA real estate, would never go below a certain price. Well, look how wrong that was. Does that mean that there should be less confidence in traditional finance? No, it should be less confidence in people who have terrible business models and who basically try and fly in the face of basic economic principles. So actually, what I think is quite good at the moment is you've got Celsius and Voyager and others taking pain because we're having a little credit cycle within crypto, and it's very welcome. It's great. Let's flush out the guys who are just lending at profligate rates, and that is the core bedrock of any economic community, is lending and borrowing. So what I'm hearing from institutions is more scrutiny on basic lending standards, and those companies that have solid, defensible, lending and borrowing mechanisms and rules are going to survive, and those that haven't are literally going bust as we speak. So I actually think it's just plain old credit analysis here that we're looking at, and I think it's all this washout that we're seeing is all welcome, because what's going to be left is really much stronger institutions.
Do you think that there's signs of maturity in the space, given that we're seeing opportunistic lines of credit being extended, that we're seeing opportunistic buyouts of firms? Does it show you a more mature space than you would originally thought?
Yeah, isn't it? It's interesting. It's a really good point, actually, when you look at the headlines at the moment. If it's not SBF, who's just is sort of blazing a trail around the world, bailing people out, which is really smart if you've got the cash. But it's others too. It's smart moves. I think you're absolutely right. Like that. It's not playground M&A, and it's sort of feels like the sort of stuff you saw in 2008. And an interesting one on that is the Middle East. Like, the Middle East is flush with cash because the oil prices remain quite high. They've been working over the last few years to understand crypto. The other place that Binance is regulated is in the Middle East as well. Dubai and Abu Dhabi, between them, have vast amounts of capital. They're starting to look at this now. Like, when you've got that quality of money that's looking at bailing out, or at least getting cheaper assets, I think that's a good sign. However, let's not over-egg the pudding. We've still got work to do, but I think that's spot on.
Thank you very much for the good question and the answers. So, trying to summarize what we talked about, if I can, is the institutions are here. They're here to stay. They make the game bigger. They make the game better. They're more professional on every level, from having the jobs of token analyst to professional risk management, to having clear rules how things work, and bringing all the knowledge how the other markets work. And at the same time, this creates opportunity for projects and people who are into the space to build stuff. So I think exciting times ahead. Thank you very much for joining.